Hey everyone. Want to record a video that I hope might be a little bit helpful for people either seeing this for the first time or for people who might have always wondered how it was done. Basically, it's just a little bit of a walkthrough of an amortization schedule for an auto loan. So basically, when you go and you finance a vehicle and you get a certain interest rate, you know, how is it determined how much of your payment goes to interest, how much goes to principal? You've probably heard that before, that not all of your payment goes to principal, especially in the beginning. But really, I guess the question is, how is that determined, or what is the method that's used to determine how much of your payment goes to interest versus principal, and how does that change over time? Um, Additionally, maybe I'd like to add another piece in here where we can actually look at how you can actually save some money once you kind of know how this works. Um, so I should say up front, I'm going to use an example that may not be representative of some of the people who might see this video, but I've done that intentionally, since really the goal here is to try to see not only how this works, but how eventually you can save some money. And so what you see is showing here my Excel spreadsheet. You can see it's empty, so this isn't pre-recorded or pre-rehearsed or anything like that. So since it is not pre-recorded or pre-rehearsed, forgive me if I stumble a little bit. I'm not always the most eloquent person. So if I fumble around a little bit, forgive me for that. But I've done that intentionally so that we can try to walk through step by step from scratch. And this is something that you ought to be able to do at home by yourself, and maybe just incorporate it as part of your budget, or just kind of your financial literacy, if you will, something that maybe help you get ahead. Since we're all working every day, or even if we're entrepreneurs, or really trying to get ahead, trying to make it, looking at trying to generate and accumulate wealth in our lifetimes, and as part of a legacy for our children, and even collectively. So let's start. When you go in to buy a car, most people who buy cars finance their cars. And I should start out by saying, there will probably be some people who say, oh, if you really want to save money, then you won't finance a car to begin with. You'll just buy it cash. And this is true. But while it is true, it is also the case that many people just don't have that type of money saved up, at least not initially. There are ways that you can save up in order to purchase a car cash, and maybe that's a video for another day. But so let's just assume in this circumstance, we're talking about a scenario where someone doesn't have that cash saved up, but they are in need of a vehicle for work or just for everyday use. Then people in that scenario, that situation, would need to finance a car. Okay, so the amount that you finance is mostly consists of the cost of your vehicle. But you should know that it isn't always the total cost. There are some other things that are in your financed amount, and sometimes they kind of sneak them in there, and sometimes you're aware. But the financed amount is basically your out the door price, meaning it's the cost of the car you're buying. It's also the cost of any aftermarkets or add-ons that they put on. So when you're in there and they say, oh, we're going to add gap, or we're going to add a tire warranty, or bumper to bumper warranty or some other type of warranty, know that those are not included in the price. They're actually added on to the cost of your vehicle. And then, taxes and title fees, all those things get added on as well. And all of those things added up is actually what you finance. Okay. So I guess maybe we'll write down. Right. That's sort of the first thing that you are exposed to when you go into a dealership and you want to buy a car. It's basically the cost of the vehicle plus all of these things that they might add on. That's your financed amount. Okay. Now the other thing that's important is how much you're going to pay in order to borrow that money, because that's what you're doing when you're financing, right? You're getting a loan from a bank or a finance company, credit union, to cover the cost of the vehicle. And so, what you want to know is not only what your monthly payment will be, which is usually how they try to sell you. They try to ask you, what do you want your payment to be? And then they sort of go from there. And they do that on purpose because it's a way that allows them to make the most money on the deal. And dealers have multiple ways that they make money. And I can pretty much guarantee that no matter how much you think you got over on the dealer in a car purchase, it's probably the case that they really got over on you. Unless you're really getting the car for less than the retail value or less than the wholesale value, the dealer has plenty of ways to make money, and they will let you believe that you're getting a great deal. But in some shape or form, they've definitely made money off the deal. It's what they do every day for a living. They're pretty good at it. And so they try to, sell you on a payment, the payment that you can afford. And a lot of people that's really what they're worried about. Of course, people that are maybe a little more financially savvy may really be concerned about the interest rate, how much it's costing you to borrow that money to finance your car. And the cost of borrowing that money is basically your interest rate. So you probably usually have heard that called your annualized percent rate, or APR. Okay. And so that's the cost, what it's costing you to borrow the money. Okay. Another lever that a dealer usually has is how long they'll allow you to pay back that money. And terms on a loan, that's what it's called. Terms on a loan can range, really anywhere from 24 months to 84 months on an auto loan. But the overwhelming majority of people financing a car usually get 60 or 72 month terms. And then, of course, once you have these three things, then those three things together will determine what your monthly payment is going to be. Okay. And there's sort of a somewhat complex formula that can be used to determine the relationship between all four of those things, meaning once you know three of them, you can find out the fourth term by always using this formula. But no need to worry. I'm not going to put the formula up there. And for this exercise, you don't actually need to know it. Just know that it exists. It doesn't appear out of the thin air or out of the blue. There is a method to the madness, if you will. But you don't need to know it for this, and you don't need to know it for the exercise that we'll do. You'll be able to do this completely on your own with some addition, subtraction, and multiplication. So let's consider an example. Let's say that you are wanting to finance a car for $20,000. Okay, so we'll put in $20,000 as the cost of your vehicle. Put a little quick formatting on there. Okay. Um, and let's say that the rate you're getting on your vehicle is 15%. And like I said, I know some people will say, that's ridiculous. I'd never pay 15% interest for an auto loan. I'd walk right out of the place. And for many people, that is probably true. But for many others, it isn't. Especially if you're a first-time car buyer right out of high school or right out of college and you don't have any credit, then oftentimes the credit bureaus or banks or lenders will consider no credit almost in the same way that they consider bad credit. And you're guaranteed to pretty much get a higher rate if you don't have any credit than if you do. So in those circumstances, you would have a higher rate. And so I'm using this as an example. And of course, if your rate is already 4%, then maybe this whole exercise is not useful for you because you really wouldn't save any money for the exercise that we're going to show a little bit later here. So bear with me. There's a reason for all of this. So let's say that your APR is 15%. That's your annualized percent rate. And all that really means is it is your monthly rate multiplied by 12. And we'll actually use that concept a little bit later. Okay, and as an example, let's just say a very common term is 72 months. So let's say you have a term of 72 months, okay? And what would be the payment on a loan that is $20,000 with a 15% interest rate and a 72-month term? Well, we can find out because actually Excel has a pretty handy list of formulas that you can use. And one of them is a formula that allows you to find out your payment if you know the other three things. Okay, so we'll put it in there. This is equals PMT. Okay, this is just us writing a formula in Excel, and then you'll see here pops up a little pop-up that shows you what your inputs need to be. Well, the first one that you need to put in there is your rate, okay, which we have above. Okay, so we'll just move our cursor up to 15%. Now the formula doesn't accept rate in an annualized way. It accepts it as a monthly rate. And so what we have to do is actually convert that to a monthly rate, which really just means divide by 12. Okay. And then you comma, and your next input is what they call your number of periods. And that's really just a way of saying term. Of course, if you're talking about other types of financial instruments, then term may not be the appropriate word to use. There might be some other ways that you wanted to note. So they just use a generic word, and that's just your number of periods. In this case, for us in the auto loan, that's your term. Okay, so we'll click on that. It's 72 months. Okay, now the next one, PV, stands for present value. Okay, and again, they try to make the terms somewhat generalized or generic so that they can apply to many different types of financial instruments. In this case, we're talking about an auto loan. So the present value would really just be your beginning principal balance. Okay, in other words, your financed amount. Okay, now in Excel, you actually have to put a minus sign since we're paying down the loan. Okay, comma, and your next input is an abbreviation for future value. And basically, what is the future value of the money for this financial instrument? In this case, your financed amount. You want to pay this balance down to 0. So your future value input is going to be 0. Okay. And then for type, they're just saying for this type of instrument, do we want to consider consider the payments as of the beginning of the month or the end of the month? And for us, we're going to use the end of the period. Okay, that's usually how people pay. Close the parentheses, and you'll see we get a payment of $422.90. Okay, now once you know this, a lot of times your finance company or your bank will send you what they call an amortization schedule in the mail. This definitely happens when you buy a house, which is a similar concept to what we're talking about here. And all that means is for every month of your term, it shows you what your payment is, how much of that payment goes to interest, how much goes to principal, all the way throughout the life of the loan. Okay? And there's a way that they arrive at those numbers, and so here is kind of what we're gonna talk about. Okay? And so here we'll just put months, okay? And under here we'll put just all the months until the end of the life of your loan. And your term is 72 months. So here we'll put 72 of those, and we don't want to type that 72 times. So we'll use a shortcut where we can highlight the cells, and then you'll see we'll drag it down, and Excel will automatically count. So let's just drag it down till we get to 72. Alright, so we have the life of our loan, which is 72 months. Okay? Now, the next thing we have, or that we want to see, is our principal balance each month. So every time we make a payment, what is the amount left, basically, that we need to pay? Okay, well, at the beginning of the first month, your principal balance is exactly your financed amount. Okay, you haven't made any payments yet, so that is what you owe. Okay, so we're going to reference that cell, put an equal sign in there, and just reference our $20,000. And I'm actually going to here put dollar signs so I can fix the cells so they won't move on us. Okay, so the beginning of the first month, your principal balance is $20,000, which is the amount you agreed to pay based on your contract. Okay, now based on that, we know that our payment, which we've already calculated, is $422.90. Okay, so let's also reference that. Okay, and we'll fix that as well. Okay, so that we have that. This is our payment. Okay, so now what we want to know is how much of that payment goes to interest, how much of that payment goes to the actual principal, actually paying down the loan. Okay, so the interest is basically goes towards, what they're charging you for money. Okay, so here let's see how much needs to go to interest. Okay, and we can calculate that. All right, and we're going to use the idea that you've been charged 15% interest. Okay, now remember, the interest we're showing here is APR. It's annualized percent rate. What we really need is the monthly rate, which we looked at before, right? Okay, so the interest is basically our principal balance times our interest rate. Okay, now for our interest rate, remember it's annualized, and since we're looking at things on a monthly level, then we need to divide that interest rate by 12. Okay, so we can have our monthly interest rate. All right, so then what does that mean? It means out of the $422.92, 250 of those dollars are going to interest. So now 1 penny of that has gone to pay down the balance. So how much does go towards paying down the balance? Well, we can easily calculate that now. since we know that our payment is $422.90, and we subtract the amount that goes to interest, and that tells you how much goes to principal. So out of your $422.90, $250 goes to interest, $172.90 goes to principal. Okay? Now, at the end of the month, after you've made your payment, then what is your new principal balance? Okay? And I'm just going to label that your end of month balance, or your EOM balance. And we can calculate that, right? It's basically your principal balance, not minus your payment, because remember, your payment won't reduce your balance by $422. Your balance will only be reduced by the amount that goes to principal, which is the $172.90. So we're going to subtract that. Okay, and now at the end of the first month, after you've made your payment, your new balance is $19,827.10. Okay, now what we want to do is basically do this all the way down 72 times. Now, of course, we won't manually do that 72 times. We'll take advantage of some Excel functionality. So first, at the beginning of the second month, what's your new balance? Well, it's the balance at the end of the first month. Okay, so we'll just set those equal. Okay, and we'll highlight these. We'll drag them down. Okay, now this already shows me that I made a mistake, and I can easily see what the mistake is. Basically, I should have fixed this value, okay, since I'm referencing it and I don't want it to change as I drag down. Okay, so now let's do it again. Okay, and I'm actually going to, alright, so now we can actually drag this all the way down. Of course, there's even a quicker solution than dragging it all the way down. Is if we highlight it all, then we can just put our cursor here till it turns to a cross and double click, and then Excel will drag it all the way down for us. Okay, so let's take a look at what we see. All right, so what we see is after the first month we have $250 that goes to interest, $172.90 that goes to principal. Now in the next month, what do we see? Well, we see that a little bit less, about $3 less, goes to interest, and about $3 more goes to principal. And then the next month, we see a little less go towards interest and a little more towards principal. So month after month, a little less will go to interest and a little more will go to principal. This allows the company basically to make their money back. It's front loaded. Okay, so it's a way that they can make sure that they're going to make their money, just in case, we decide not to pay. All right, now if we scroll all the way down, what will we see? Well, we'll see eventually that when we get to the bottom that you're basically near the end, almost none of it is going to interest and almost all of it is going towards paying down your principal balance. And then in the very last month, what you'll see is you have $417.68 left to pay. Okay, make your payment. $5.22 goes to interest. The rest of that, which is the $417.68, goes to principal, and you're left with a zero balance. Hooray! Your car loan is paid off, and everything is wonderful, right? Not so much. Well, let's just take a look at something, okay? Remember that this column D is all of the interest that you've paid every month, okay? Well, let's take a look and see exactly how much that is. So we'll just type a sum, okay? And then highlight all the way up. Close our parentheses. Okay, now what this says is that on top of the $20,000 that you had to pay back, you've also paid $10,448.82 in interest. Okay, it's pretty steep. So all in all, basically, you've paid $30,448.82 for a car that was really only $20,000. Okay, this is the cost of not having cash up front. Okay, it's the cost of the money. Now, what we want to do is try to look at some ways to maybe bring this down. So like I said, maybe at this point in your life, you're a first-time car buyer, or maybe you've had some credit challenges in the past. Things happen. We had a terrible recession. Even some people are still recovering from that. So it may be the case that when you needed to buy a car, your interest rate was 15%. Okay. Now, of course, eventually, maybe you want to try to refinance your rate if you make the payments regularly. But what's another way that you can try to save some money, knowing that this is your rate, this is what it is, you have to pay it? I mean, it's based on your current circumstance, either a first-time buyer or had some credit challenges. That's what it is. This is how you need to pay for the transportation that you likely have to have. Okay? Well, one way that you can save is, remember, this is the interest that gets paid every month. Okay? In the amount, the way that your balance is reduced every month is based on how much principal goes towards your balance every month. Okay? Well, we can change that a little bit. And one way that some people do this is to pay a little bit extra every month. So instead of paying $422.90, maybe we pay, let's say we maybe pay $600 every month. Well, that extra $118 or so would go towards reducing your principal. Okay? And here, what I want to do is try to show exactly how much that reduces your principal. What is the impact of that? Okay, if we were to do something like that. All right. So let's say now that instead of paying $422.90 every month, let's say instead we propose that you pay $600 each month, if you have a little extra to do that. Okay? So now, basically, we're going to create another one of these amortization schedules, but this time we're going to include the extra that you put towards your principal balance every month. Okay? And so let's put one more description here. Okay, and what we're going to do is we're going to say that basically if you pay $600 every month, the additional money that you're paying, basically the additional money you're putting towards principal balance, is just the difference between what your real payment is and the amount you will actually pay. Okay, and so let's just do a subtraction, and basically this is you're going to pay $177.10 more, okay, on top of the $422.90. All right, so let's see what that does to your balance. And what we're going to do here is we are going to create another one of these. All right. Very quickly, I'll move a little faster this time. Just so we can get to the good part. At least I hope it's the good part, which is saving money. Okay, and then these here. Now, you'll notice I didn't put the end of month balance part, and that's because I want to insert a portion that basically says your additional principal. Okay? Alright, and for that, what we're going to do is we'll just reference the cell, which basically is the additional amount that we want to put towards our principal. Okay, and then we'll fix that cell also. Okay, then we'll put this other column there. Alright, so now remember last time we merely subtracted your principal balance minus the amount that goes towards principal. Yes? Okay. Well, now we're basically going to do the same thing. Okay, so we're going to subtract the amount that normally goes to principal. But now remember you're paying an additional amount which will also all go towards your principal. So we'll subtract that as well. Alright, and now your final value, you'll see if we do a comparison, you have $19,650 at the end of the first month versus $19,827 at the end of the first month. So you'll see that you've actually reduced your principal balance much more than you normally would by paying this extra amount. Okay? So now, what we're going to do is we're going to drag these down. Okay? Alright, and then drag these all the way down. Alright, so now let's take a look at what we see. And remember, we basically want to get to a point where this end of month balance reduces to zero. That's what we saw before, right? At the end of 72 months, we had zero balance left. Okay? Well, now let's take a look. Now that we're paying this additional amount every month, okay, then when does this reduce to zero? Well, basically now we see that we reduce to almost zero in 43 months. Okay? So now basically you'd be paying off your car in 43 months instead of 72 months. Okay? By paying a little bit extra every month. Alright? Now the other thing we want to look at is how much you actually paid in interest. Okay, now remember before we saw that we paid a total of $10,448.82. Well, in this scenario where you pay a little extra every month, how much do you actually pay? Now I could see the sum if I just highlight all these cells, but I'll actually write a little formula here. Okay, and let's sum up the interest. Okay, so now you've actually paid off your vehicle and you've only paid $6,031 in interest. You've basically saved about $6,400. Okay, you basically saved about $4,400 in interest. Okay, which is a significant amount. Okay, now what you could also do, which we won't show here, but what you could also do to actually even further reduce the interest that you're paying is to try to pay a few days early every month. Okay, see, all of this is about accumulation of interest over the life of the loan, which is set. Okay, but if you pay a little differently, then that changes how the interest accumulates. Okay, now this works against you too if you pay late. Okay, if you pay late every month, then you actually give more time for interest to accumulate on your principal balance, and you will actually end up paying more, a little more than you should. Okay, but if one, you can pay a little extra every month, and two, maybe pay a week or so early every month, or even a few days early every month, then those two things will allow you to save on interest. So if you only paid an additional $177.10 every month, then you would pay off your loan almost 30 months early, okay? 30 months ahead of time, and you would save about $4,400 in interest, okay? Now you'd save even more money if you actually paid a few days early every month, okay? Like I said, we won't show that here, but it definitely works out that way, okay? So this is one thing you could do. Now, you could save even more money, okay? If instead of paying all the way to 43 months, let's say instead you said, after 24 months, I've paid every month, maybe I've even paid a little early every month. This would definitely be reflected on your credit bureau, okay? Which means you would have an improvement in your credit score, either your FICO score or your Vantage score, whichever score is being used by car companies, okay? So at this point, you'll probably already start receiving some emails or some letters in the mail saying, do you want to refinance? We can save you money, okay? And you can save even more money than what I've shown here if, for example, at 24 months, you say, I've paid on time every month, or even a little early every month. I've paid extra money every month to reduce the principal balance further. Let me see about refinancing my vehicle. Okay, and refinancing your vehicle would mean that they're now going to offer you a lower rate, okay, than what you currently have. So currently you would have this 15%. Another company would come along and say, we can reduce that rate by X amount. Okay, maybe they can cut this in half, or they can reduce it some amount based on your credit history, based on seeing that you've paid regularly and on time for the current loan that you have. Okay, and because remember how this works here, this interest basically gets applied every month to your principal balance. Well, now if they've lowered this, okay, well then that means there'll be less interest every month. So now instead of having the 15 divided by 12 multiplied by the finance amount here, it'll be whatever the new lower rate is, okay? And based on that, you will actually save a lot more money on this. Okay, and then this has a lot of other types of impacts that could be helpful going forward. For example, if you've paid off early and you've paid the principal balance down, if you've at some point after you refinance, you decide you want to trade your car in, this will be helpful for you, okay? Because now that you've paid down the balance earlier, versus how fast the vehicle value is decreasing, this would be advantageous to you because it would actually work in your favor in terms of your loan to value on the vehicle. And loan to value is one of the primary or key components that auto finance companies use to determine your rate, okay? We won't go into that, although maybe a later video we could. But this is just another kind of aspect of this that could be helpful. But this is sort of what I wanted to show everyone. I've been asked before, how exactly are these rates calculated? How exactly do they determine how much of your payment goes to interest versus principal? And maybe we've all seen what our amortization schedules look like before. And maybe we wondered how they actually come up with these things. And this is how they do it. Okay, it's not rocket science. It's not something you can't do yourself. We just did that here with Excel. And anyone who has Excel could also do this. We didn't use any sort of fancy math. Although there is some fancy math behind this, we didn't use any of that to produce this. We basically used some combination of addition, subtraction, and multiplication to produce what we've had here. And hopefully, with what you've seen here, this will give you some idea on ways that you could save some money. And really, saving money or reducing your costs overall is really what, sort of helps you to begin to accumulate wealth, which overall is the goal, right? To accumulate some wealth, accumulate enough that you can leave some also for your kids, and your kids can accumulate wealth and leave some for their kids, and really just start a pattern. Okay, but that accumulation really starts with some of these little things here, and I don't know if we call this a life hack. It's just something that you can do, and there are lots of other things you can do too, but can't talk about them all in one video. So I hope this is helpful to people, that people can use it. This is my first video, so if I fumbled around, if I've made some mistakes or some grammatical errors, or even if I made some mistakes about some math things, forgive me for that. But I hope that this was helpful for everyone, that anyone who's watching actually got something from this, something that they can use, even if it's just for curiosity's sake. Maybe, like I said, your rate's 4% already, none of this is helpful to you, or you bought your car cash and this is not helpful for you. But maybe you just happen to wonder how this kind of all works. And so for that person out there who might be seeing this, I hope this sort of help quench your thirst for knowledge or your curiosity. But basically that's all I have here. Maybe I'll do some more things like this going forward. Maybe I'll talk about your credit score, what a credit score is, what it means, maybe what are some of the inputs that go into a credit score, how that's impactful, and maybe how you can manage some of those things to improve your score, or understand the score better, so it doesn't seem like such a mystery. And there's lots of things we really could talk about and discuss, but just some things that we can try to do, so that we can all benefit. I learn a lot about things from either my colleagues, my friends, family, or just other things that I might read about or see online. And I thought that maybe I had something to share that some people could benefit from as well. So I hope that is the case. And I don't know if I'm having trouble closing this down or shutting down, but I think that's it. So let me know, give me some feedback. Always open to constructive criticism. Maybe how I could have done this better, if I could have explained things in a more clear way, more concise way, or somehow made it easier to use, or if you just have some questions about what we did, what we didn't do, let me know. Okay? All right. Thank you.